Hello and welcome to our Friday macro wrap-up, where we take a deeper dive into the macro credit data, answer your questions, and try to make sense of markets that how can they actually make sense when you have about 50% of all Americans out of work and stocks go up? I mean, how does that make any sense? Well, we're going to answer that and more of your questions. I'm Steve Van Metre. Thanks for joining me. And I want to start out by talking about crude oil, because crude oil prices have been rising along with inventory levels. And while people are very bullish crude oil, it kind of makes you wonder, do they even know what they're doing? Because last month we found out something about this thing called May expiration in futures contracts, which a lot of people had no idea what that was until they found out that crude oil prices can actually go negative. Now, that was a bit of a surprise even to myself, who had predicted they were going to zero or negative, but sometimes when you make crazy predictions, they do happen. But people have piled back into crude oil thinking, well, this is the right time, it's so cheap, how can I go wrong? And I bet not many of them know that in less than 2 weeks, the June expirations are coming. And we've seen, again, no draws in crude oil. And we've seen people buying it. And there's more ships on their way all month from Saudi Arabia to the tune of about 34 million barrels of oil. Kind of makes me wonder if they know what they're doing. But is there a chance we could get a repeat of last month? A lot of people say no. I say, I think we can. I think we can. So let's talk about the Nonfarm payroll report. There's really not much to say in terms of digging into the data. When a report comes out and shows 20 million people unemployed, and keep in mind, this report was only good through the middle of last month. There's not the total picture. There really isn't much of a response you can give that. But other than asking yourself, well, why are the markets reacting the way they are? And there's two real good reasons why I believe the markets are behaving the way they are. One, when they did the payroll report, they found out that out of the 20 million people, 18 million of them think they're going to be back to work in 6 months. Yeah, I don't think that's going to happen. And then there was another survey just a couple days ago that said that 50% of all small businesses will be closed in 6 months. And my thought is, it's going to take that long? And I'm not trying to be negative. I don't want that. I'm just trying to put my macro hat on and trying to understand, do small businesses really have that much cash? I didn't know they did. I'm a bit surprised. Maybe I'm wrong. Maybe they're getting, some loans from the government. Maybe that's going to happen. I don't know. But it seems a little bit optimistic on both sides that people are going back to work. And then I ask the question is, okay, for those who do go back to work, are they going to get the same amount of hours? Are they going to get the same pay? Are they going to get the same bonuses? My guess is their hours are going to be shorter, their pay is going to be less, and so is demand. I just don't see it playing out. Now, maybe investors believe that. Maybe that's why they're playing chase in this market. That could be. I don't think that's the entire reason why. Although, there are people that believe that not only is the economy going to rebound, but it's going to be so strong, it's going to be stronger than it was before, which was odd because before it was bearish, we were heading into a recession. I mean, it was already slowing down well before the coronavirus effect hit. So what is the other reason is, well, people put a lot of faith in the Fed and the powers of the Fed, even though there's really no evidence the Fed can do half of what they claim to hold asset prices up and stock prices. Not that you'll see a Fed chair come out and say, hey, we're doing this to support the stock market. We all kind of know that's what they're trying to do. But they didn't accomplish that goal during the dot-com bubble. They failed. They didn't accomplish that goal during the great financial crisis. But the reason investors seem to think that this time is different is because it's all, well, more. If 60 billion a month of QE didn't work, let's do 600. Or why not do 6 trillion? Why not do 60 quadrillion? Why not just do so much? Because is the real answer, we wouldn't have the great financial crisis if the Fed would have just injected more liquidity in the banking system. Really? I don't think so. But see, there's a lot of psychology that goes on in the markets. And from the macro world, you have to understand that. Because quantitative easing can become a self-fulfilling prophecy. If I believe that quantitative easing causes stock prices to go up, well, then I could simply buy stocks. And by buying stocks, that might cause them to go up. And then you might say, hey, look, stocks went up, but you didn't know it was I that was buying, so you go and buy, and then stocks go up. And then someone else says, hey, look, the Fed's doing QE and stock prices are going up. I'll buy too. And next thing you know, buying begets buying, and stock prices rise, and it becomes a self-fulfilling prophecy. It's kind of interesting. I think that's what's mostly going on, and we do see that in prior recessions where people just believe. Now, you'd think after 2 recessions where the Fed did everything they could or thought they could at the time to bail us out, that people would have learned. But investor memory is short, very, very short. Will it end the same way as it did in the past? Yes, it will, because next week I've got this great piece, probably going to save it till Friday, where I'm going to prove to you even more proof than before that quantitative easing really doesn't do anything. I'll show you exactly what it does do. I've got a cool little graph of world dollar liquidity and how we're going to inject quantitative easing into that graph to really show you what the Fed's trying to do and why it doesn't work. But I want to spend some time talking about inflation. And a lot of people get inflation wrong. And I know I'm not wrong, and I know the world thinks I'm wrong, and I'm okay with that. But everybody thinks these Fed policies are inflationary. Well, why weren't they inflationary during the Great Financial Crisis or the dot-com bubble? Oh, I'm sorry, they just didn't do enough. No, people don't know what inflation is. So let's go through. I spent a lot of notes on this. So what is really inflation? It's expansion of the currency supply. Now, we do know the currency supply expands way more than the Fed wants it to, but they need it to for the global economy to grow. So they use things like consumer prices as a gauge. Now, inflation is not necessarily higher consumer prices. See, people get this wrong too. They go, well, look, the CPI is going up, Steve. Can't you see the higher prices are inflationary? Well, I'll tell you, supply and demand imbalances are not inflationary. So the fact there is a beef shortage right now and prices on beef are going up, that is not inflation. That means there is more demand than there is supply. There's nothing to do with inflation. It's just, that's all it is. It's a supply and demand imbalance. Now, will consumers stop eating beef to switch to something they can get their hands on, like chicken or pork? And I have no idea what is available. I try to avoid the stores as much as possible. Like some of you, I'm not interested in trying to get this thing. So I buy a couple weeks at a time. And so right now I'm not being impacted by that shortage because I somehow got ahead of the curve slightly for a change. But supply and demand imbalances, it's not inflation. And higher consumer prices in general, I mean, have you ever really thought about why consumer prices have to go up? I mean, if you look at a chart, I'm not going to pull one up. Why do consumer prices seem to go higher and higher and higher like this? Year after year, even in recessions, they tend to go up. They might dip, but they tend to still trend higher because of the debt. You know, people take on more and more debt. Businesses take on debt to expand. How do you pay for it? You raise your prices. Chart consumer debt or federal debt against consumer prices. You'll see as debt goes up, you got to pay for it. You got to have higher prices. You know, inflation is only evident when prices are rising and there is an equal expansion in the money supply. Now, we do want to know the money supply is expanding, but it's due to money flowing into institutional money funds, not really, I mean, there's some other stuff going on, but it's not due to inflation. The Fed's money printing, so to speak, is not transmitting down to the real economy. You know, the Fed doesn't force people to raise their prices. I don't get a call from the Fed and say, hey, you should raise your fees to your clients. I don't think anyone else does either. So the Fed cannot directly control that. And nor can they magically elevate stock prices. You know, think about it. You know, we assign the Fed and presidents, and no, I'm not specifically referring to any one particular Fed chair or any one particular president. But do you think if a president could make stock prices go up? I mean, do you think they get in the White House and there's a wall of knobs on a board and they're like, gee, I want people to be out of work, so we'll just dial the... No. They'd be like, oh, max employment? Yes. Max wages? Yes. Max stock market? Yes. They turn all the dials to max. They don't have that power. I mean, could you imagine if you had the power to make everyone rich, everyone employed, everyone happy? That would be an interesting world, would it not? So no, the Fed does not have that power. We give it to them, but they don't. The Federal Reserve Act itself prohibits the Fed from printing money. This is really key. Now, I've read the Federal Reserve Act. I know that's what it says. I'm just giving it to you in layman's terms. It's pretty much, that's what it says. The Fed cannot print money. They do not have the tools, the mechanisms, or the ability to print money. Period. They can only lend money. And we've heard Fed Chair Powell say that recently. Hey, look, I can only lend money. See, modern monetary theory, neither modern nor a theory, because it's been done before, not by us, but at other countries, is direct money printing. Lending is not printing. Fed Chair Powell is very, very clear about that, and he's right. And they can't lend direct. Like, I don't have a Federal Reserve credit card. Now, that'd be pretty sweet, but I don't. You don't either. Your loan is not backed. Well, they might own the mortgage, but it's not like you go to the Fed and be like, I'd like a mortgage, or I'd like to get a loan. Or business can't do that either. The Fed only lends to the banks, who then in turn lend to us. That's an important factor here. Because when you understand where inflation comes from, it comes from you and I. When we borrow money. See, it's borrowing money that creates money. It's not the Fed doing things. All the Fed can do is lower interest rates enough to see if we want to borrow. And if we don't, they lower it some more. That is where inflation comes from, because the banks, the banks are the only source of money creation in our economy. When people borrow money, that's where it comes from. Because see, the Fed has two policy tools we talked about. They control the federal funds rate and the monetary base through quantitative easing. So they can raise and lower the federal funds and the monetary base. That's it. That's what they can do. Yeah, they can do some other lending stuff, but the big tools are federal funds rate and the monetary base. And they do the same thing. They're the same tool. They just work a little bit. They just aren't the same. They just two different levers on the wall. Hey, lower federal funds rate, quantitative easing. What does it do? Causes interest rates to go. Where's my yields? Down. You want to raise rates? Quantitative tighten, yields go up. There you go. That's the Fed's policy tools. They only have two of them. Now, when you look at what the Fed can do, and we've heard former Fed chairmen say this before, is they can stop inflation anytime they want, because all they have to do is raise interest rates until money creation stops. And what is money creation? Lending. Now, how would I do that? Let's exaggerate. What if the Fed made the federal funds rate 10% on Monday? They come on Monday, hey, we're going to put the federal funds rate at 10%. Do you know how many people would borrow money? None. You'll have people in the stock market, boom, be selling like crazy. And they would stop inflation. Are you going to go get a home loan at 14, 15%? Car loan at 18? Nope. Credit card at 40? No, not funds rates 10, you're not. And that's how they stop the movement of money. Now, how do they create it? Because everyone thinks, well, the Fed can just create it, then can't they just lower interest rates and create? Okay, so let's say the Fed makes interest rates minus infinity. I'll go to the screen. Minus infinity. Is any money created? No. Because how many people have borrowed against it? There you go. See, that's the key. The Fed can lead consumer, right? Hey, Steve, come down here into the bank maybe because interest rates are really low. But I'm like, yeah, I don't really want to borrow. No money's created. That's where inflation comes from. That's why I say that easing monetary policy is not inflationary until it is. So right now, low interest rates are not inflationary because people can't borrow. People on unemployment aren't getting loans. Could you imagine that? Hey, Mr. Banker or Mrs. Banker, I'd like to get a loan. Oh, can you show your source of income? Yes, from the state of California. Turns out unemployment is bye, right? So when the Fed eases, they tighten monetary policy until it's eased enough to create inflation. And we see all of this in the credit data. And that's why we look at this stuff. And the real big source of inflation is the world dollar liquidity cycle. And why is this create inflation? Because the first step is consumers buy foreign goods and services with borrowed money. We take a loan. Money gets created. It flows to foreign companies who exchange it to their foreign central bank for local currency, who then send it back to the United States to buy U.S. Treasuries, and then the federal government runs deficits, shoots money back out in the real economy where we take on more and more debt. And you could put businesses here too. It doesn't matter. As long as somebody in the United States is deficit spending to buy foreign goods, you've got something that creates money. That's how dollars get expanded. And is there a lot of global trade going on right now? No, not at all. But this is why we look at the credit data. It's so important. So let's take a look. And what do we see? That we know the Fed backed off quantitative easing just a touch. They just announced that today. That they dropped by $1 billion a day of Treasury securities and $1 billion a day of mortgage-backed securities because the banks have been complaining effectively about a shortage of Treasury securities. And lo and behold, they bought $33 billion worth of stuff last week, including mortgage-backed Treasury securities. They were on the buy. So you have $33 billion plus what the Fed did. That's pretty good. And it's worth noting that the banks were buying this when 30-year yields were around 1.2%. So it'd be interesting to see if they're buying more this week with yields up, because I always like to think the banks are behind a lot of this manipulation and letting yields move to their favor. Let's look at all loans and leases, because if we want to see inflation, we should see it here. And we see, okay, yeah, there was an increase in lending. Where was it? $18 billion in commercial and industrial loans. Is this going to build new factories, hire new people? No. It's going to keep businesses in business, not inflationary. It has to go into things that create more income. So if you're going to borrow $1 billion, it needs to turn into more than $1 billion. Let's look at real estate loans. Down $3 billion. Residential, down $1 billion. Commercial, down $2 billion. Nothing going on there. How about the consumer? Because here's really where everything's at. Down $4 billion, which is substantial. And we see credit cards as the biggest source where this happened. And what's interesting is we just got the monthly credit data the other day, and the answer was, oh, Americans are paying off their credit card bills since they're at home. Really? Yeah, I'm sure some people are. I bet you a lot of people are defaulting or not paying. I don't think people are sitting at home flush with cash. Now, there are some people that do have extra money, but are they particularly paying down their credit card with it, or are they worried about the future? And then those that don't have enough money, where you see out, at the food lines, yeah, I bet they're not making extra payments on their card. I bet you they're not even making payments. And we can see some of this damage when you look at the consumer loan data that's coming right out of that report, and you can see this big drop here. It's unprecedented. There's really never been a drop in credit card data this steep, this fast. So it's telling you there is no inflation. There's something wrong with the consumer. There's something really wrong. Let's take a look at some of the broad data. The money supply is rising. It's starting to slow down a bit. The key point to the money supply is the growth rate in what's flowing into institutional money markets. And it's still growing, but it's starting to slow down. So the trend here is slowing. The monetary base is still moving strongly, even as the Fed tapers. I mean, this thing is just, growth rate is up 58% from last year. This thing is moving hot. And as a result, the money multiplier, the easiest way to see inflation, is falling. And we're right about where we were here now. And what's going to change this is all of a sudden the money flowing into institutional money funds will start to slow down. That's what will change. And how do we know where interest rates are going? Well, that's really easy to look at, because when we take that same data and we overlay 10-year Treasury yields, there's two conclusions we can make: that yields have moved too fast ahead of the money multiplier and need to come back up, or yields know what's really coming and that rates are going negative. And with every passing day, it looks like rates are more likely to head negative with the long end of the curve smacking hitting zero. It's really looking like that. We'll come back and look at some more of those charts in a moment. Let's continue on. So real estate loan growth, again, here's the consumer. Growth rate's down to 4.35% from a year ago, so we're not seeing huge demand here. Across all metrics, it's falling. Where is the growth coming from? Commercial industrial loans, and guess what? It's slowing now. This looks like could be the peak. These numbers barely went up, but they did go up. So we might be at the end of the borrowing binge for commercial industrial loans. And when we take a look at total loans and leases, it's starting to slow down too. It was flat on a year-over-year basis, slightly rising on a 6 and 3 month basis. And then, of course, the consumer loans, the credit card data is down 4.63%. Unprecedented. This does not happen. In my opinion, yes, there are some people that are fortunate enough, they're working from home, spending less money, paying down their debt. There's a lot of people that probably just aren't paying their bills. In addition to that, we see net exposure of equity long short funds back at record long levels. They're buying stocks like crazy. Even though hedge funds are still short in the futures market, they are buying stocks. A lot of people are buying stocks. Again, maybe due to the magic of the Fed. But this was a great chart posted. I saw this on Twitter from DataStream Market Economics and Pickett Asset Management showing global manufacturing surveys versus 10-year Treasury bond yields. And look what it's showing, that 10-year Treasury yields are likely headed negative, and supports my thesis that that is likely where they're going. Now, I'm not going to hold myself to say they will be negative, but they're headed lower. There's no doubt in my mind. And we know that obvious for lots of reasons. Let's look at some of the other data we saw this week. Labor force participation rate tanking. And as a result, the velocity of money, or how fast money exchanges hands, falling. What happens to interest rates? Well, when you overlay a 10-year Treasury yield against the labor force participation rate, it tells you that yields are headed lower. Fewer people working does not cause interest rates to go up. It does just the opposite, because you can't get a loan if you're not working. And if you're not working, that means what debt you are paying is causing rates, is shrinking the economy by contracting credit. I'm not contracting credit, by paying off the balances. And there you go. Let's keep on. Treasury deposits for the Federal Reserve Bank shooting higher. Usually when this happens, it puts downward pressure on yields. We've seen that happen in the past. And there is one case where it didn't, but the economy was growing fairly strongly compared to now back in 2017, 2018. Obviously not growing. So the Fed is just pulling money out of the economy. That puts downward pressure on interest rates. Let's take a look at institutional money funds. Money is still flowing in here. It's starting to slow a little bit. We'll see if it comes to a stop here pretty soon. That puts downward pressure on interest rates. How about the Fed's balance sheet? Well, that puts downward pressure as the Fed continues to do quantitative easing. Interest rates go down. Again, it's all the same data, just looking at it from a different picture. How about the unemployment rate? Well, when we invert the unemployment rate, we see that falling, obviously because it's inverted. What does that mean for 10-year Treasury yields? They go down. How about stock prices? Well, they tend to follow the unemployment rate too. Again, shown inverted. When the unemployment rate goes up, or shown inverted down, what happens to stock prices? Not today. Stock prices go up because guess what? QE works. No, not for much longer. It's not. And then people are going to find out that psychological effect, toast. And the last chart, we'll save that for the questions. We will save that. Okay. Let's get into, I want to look at some charts real quick here. I want to look at Treasury yields, and then we'll get into your questions. There's really nothing to look at the stock prices, but Treasury yields is interesting because they've been in this multi-month sideways pattern, oscillating between 1.4 and 1.2% on the 30-year. And so this is 1.4 here, 1.2, 1.3 in the middle. And yesterday we saw them dip down, get close to 1.3, and then today, sellers came in pushing them higher. This is not going to hold. This is a consolidation pattern. When you see on a price chart a sideways pattern like this, where it's kind of in a rectangle and it's bouncing between, most of the time it's a continuation pattern. Most of the time. In order for it to be a bottom, you need to see something a little bit more extreme in the price movements. But sellers are desperate to get this thing to go up, and the reason is simple: because the jaws must close. And you can see on just a 6-month basis, stock prices are rising, yields are falling. That doesn't make any sense. If we go out to the 1-year chart, we can see when stock prices rose against yields flattening and falling, they came down. Here again, yields are flat, stock prices are up. We can keep zooming this out, and all we see is more exaggeration of the jaws must close. Who's going to be right? Well, it's pretty obvious with half of America out of work that the bond market's going to be right. But sellers have to sell. They have to keep putting pressure here. And what did we see on TLT, which is the largest ETF by volume that matches 30-year Treasury yields? And we see, and I'm not a huge investor, but moving averages are interesting me, but I don't place a ton of stake on these things. But today, the TLT came down, held its 30-day or 50-day moving average. And moving averages is pretty simple. They just tell you what the trend is. And you can see when you're in a bull market phase, it'll bounce kind of off its moving averages. And even in here, I was still very bullish. Even as the moving average rolled over and trended down, I was very bullish. I said, look, this is a consolidation pattern headed higher. Boom, it headed higher. Now we're getting our first tag at the 50-day. Well, will we get, I doubt we'll see a tag at the 100 or 200, but you can see bull market rallies tend to start with the confirmation at the 50-day and then repeated bounces off of it till it peaks. So to me, everything I see here validates what I see in the credit data, validates what the Fed's doing. It says, okay, well, that wasn't a fun week for owning bonds, or maybe the last 2 weeks, but as long as it holds this level, then prices will move higher. That's how these patterns tend to play out. So you have buyers down here where you get sellers selling until they get exhausted, and then buyers come in. And then up here, buyers get exhausted and sellers come pushing back down. So I see all of those things happening, and I'm neither concerned nor worried about the bigger picture because all my data says I know where interest rates are going. All right, first question comes in from my wife because she gets priority on questions, as you know. And she says, JCPenney is filing for bankruptcy. What does that mean for the company? Does that mean they still have a chance to try again, or are they done for good? I'm submitting my question for your video, lol. So the answer to that question is it could be either. They could very well decide to close shop and just sell off the assets to someone else. That's possible. Not that common of a choice, but that is possible. Another option is they can go to bankruptcy court, wipe out the shareholders, wipe out some of the debt, get some other debt written down, restructure it with the banks, fire the board, fire the executives, and this is where the employees become major shareholders of a corporation. And who knows, there could be some asset sales. They could say, hey, the judge could say you need to get rid of, your 20% of your worst selling stores. You need to get rid of some of your property. You need to get some cash and put towards some of this debt. Effectively, the company can get restructured. A new board can be hired. Again, this is where you see the employees take over companies. That's why a lot of people, and there was a great video, I think on CNBC by this hedge fund manager where he just ripped apart corporate bailouts because he said, look, we have bankruptcy courts. This puts the power of a corporation into the hands of the employees and gets rid of all the bad stuff. Well, he was right. So no, it doesn't mean JCPenney's going away. They might come back as a new brand, or maybe with the same name but a new marketplace. I don't know, but does not mean they're done at all. All right, on to your questions. I want to thank you for the great job you've done with your videos. You're very welcome. I personally learn a lot and enjoy hearing your point of view on a regular basis. Cool. Well, I'm really glad to have you. The question, I've heard you mention that gold miners will one day be in demand. Let's just say gold, so we're not talking something specific. I understand this time is not right to own them because we're going to experience more deflation. That is my opinion. Now, for some years, the question followed up, for some years, I don't know if it's going to be some years, but they're definitely going to see deflation. What do you see as a potential scenario that could create demand for precious metals or miners? The answer, which I think we looked at the other day, but we'll do it again because I should have merged those questions together, is real yield. I think real yields are headed higher as the consumer price index is headed lower, and interest rates are, I think consumer prices are going to go down faster than interest rates. That will send real yields higher. And then eventually when real yields peak, they tend to roll over. Could be over a period of time, could be very short, and that tends to correlate, not a guarantee, but tends to correlate with the gold market. Next question, does it have anything to do with the fear that the U.S. government will one day default on its debt? No, the U.S. government cannot default on its debt. The Fed will not allow that, which would cause the U.S. dollar to lose the status as the world's reserve currency. Well, the Fed will not let that happen. Now, if the Fed buys all the debt, what's going to happen to world liquidity? Well, it's going to be very inflationary for a lot of other countries. It doesn't make any sense that they would do it, but no, we cannot default on our debt because the Fed has the authority by the Federal Reserve Act. See, a lot of people don't know this because they don't bother reading. They just listen to what other people say, and they're wrong. In the Federal Reserve Act, the Fed can buy an unlimited amount of U.S. Treasury securities at any time without approval from anybody. So if China said we would like to sell all of ours, the Fed could effectively write them a check and say, here you go, we'll take all of it right now. China's not going to do that. At least I don't think they were. When did you come up with your thesis? Years ago, 3-4 years ago, when I was on the wrong side of the bond market, and I realized I needed to learn a lot more because what the mainstream media was, financial media was saying, and what was actually happening were different. So I retooled my view and hit the books and started studying. Is there a chance it keeps dragging out longer than anticipated? In the world of macro, that always is the case. I thought we would see a turn down a couple of years ago. We haven't had that yet, but I think we're closer to seeing my view play out, much closer. Once this consolidation pattern in yields is done, and I think 30-year break 1.2, I think there's where we see that move to zero and that I play out right. I mean, the money multiplier is moving down. I mean, everything that I would want to see happen is happening. The only thing left would be the flow of money into institutional money funds. When that slows or kind of temporarily stops, or maybe even reverses a little bit, as long as the Fed keeps easing, it's a done deal. Next question. Since I've discovered your channel, I watch all your videos religiously. That's awesome. Thank you. And can hardly wait for the next episode. Well, here you go. Here it is now, and here's your question. Thanks very much for enlightening content. 2 questions. With regard to your proof that QE is deflationary, does your analysis take into account the potential indirect impact of modern monetary theory? Well, we're not using modern monetary theory. It's not in place. There's no evidence from Fed Chair Powell's recent press conferences or testimony that he has any interest in doing that. And while Congress could change the law of the Federal Reserve Act, I mean, that's their job to change law, it's likely that such direction would come from the Fed chair, and it's not likely that it would be something that would pass through Congress quickly. It would probably take years and probably would never happen. There's a lot of people that may say they want MMT, but it would cause the dollar to hyperinflate. So no, I don't take in the impact of MMT because there's no way MMT is going to happen before my thesis plays out. Indirect impact of MMT on fiscal measures such as the Paycheck Protection Program. It doesn't matter if the government forgives the loans, the government's still carrying the debt, so they still have to issue it, and that doesn't change anything to me. Second question, do you believe the inevitable period of deflation will eventually fall by inflation or hyperinflation? I'll say high, a very short burst of high inflation, much like what we saw in the great financial crisis. What will depend is when yields hit zero or get really close to it, how far up they will bounce from that. I have a hunch they will at least get back to where they are now. The higher they go, then we know the consumer price indexes will lag it on the way down and then overshoot it on the way up. And so, yeah, I think it'll feel, people will get panicked and think it's hyperinflation, but it won't be. It'll be just a very high rate of concentrated inflation, and then it'll roll back over into deflation. Because, again, our monetary system cannot create inflation. It is designed specifically to stop inflation. That's why we don't have it. The only way we're going to get it at this point is if we find a way to devalue the dollar, and I don't know how that's going to happen exactly. All right, well, let's leave off there. Those are some great questions, and then we'll get back to your questions on Monday. We'll take a look at how hedge funds are positioned, see what other interesting macro things may come over the weekend or on Monday. But either way, I'll be here. I hope to see you. I'm Steven Van Metre. Thanks for watching. The content of this video is provided as education information only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that one do not reflect the view of Atlas Financial Advice, Inc. or Steven Van Metre Financial.